You're watching us here on Chartbusters on CNBC-TV18, and as we speak, we have the markets falling, but one of the stocks on our radar is Godrej Consumer. Reported a weak set in the third quarter, but as the company had guided us earlier itself, that it would be a weak quarter on account of the rise that we've seen in palm oil prices, and at the same time, we've seen some weakness in demand sentiment as well. Asif Malbari, who's the Global CFO and President of the Middle East, Africa and International Markets Business, joins us now. Asif, you earlier called out the weakness in the third quarter. The results reflect that as well. The question is, what next? From the peak, palm oil prices have come off. The street is expecting demand to come back as well. We've seen some recovery in FMCG stocks from the lows as well. Do you believe that, the worst is behind? What are you seeing in this quarter so far?
Sure. No, so thanks, Mangalam. I think one, as we had called out, this was a quarter where we had seen a lot of temporary headwinds against us. And we saw these in two of our core categories. Personal wash is going through a fair bit of commodity inflation, as a result of which a lot of pricing has gone into the market. As we indicated in this quarter, while we kind of saw mid-single digit declines, we actually kind of broadly offsetted most of that with price increases, with giving a flat revenue kind of growth in the category. And then we had some bit of, again, temporary headwinds in terms of HI, where seasonality did kind of not support us in the best of the fashions. So we do kind of see these kind of reverse off as we kind of move on in next quarter. Definitely, there will be sequential improvement. Having said that, we've delivered last 6 quarters. We have been delivering broadly in our India business a UVG of 6 to 7% weighted average. And this was a kind of, I would say, a quarter which we wouldn't want to kind of remember in terms of a growth delivery. There is always an effort to kind of get back to that level of delivery. We should see a sequential improvement. And I think as we get into FY26 in first half, we should kind of start getting back onto those kind of trend lines.
All right, sequential improvement in the fourth quarter and get back to 6 to 7% underlying volume growth in the India business as well. But what about the India business margins? How long before you claw back to your earlier guided range of 25 to 27% point? Because you had been talking about that for the last many quarters. The last couple of quarters have been an aberration. If you could give us a newer range that the street should be working with as well, and how long before you get back to this 25, 27%?
So I think let me kind of break this margin piece in 2 parts. If you kind of see historical consolidated margins for GCPL, they've actually been between 18 to 22%. We closed margins last quarter at a consolidated level at 20% plus. So from a consolidated margins perspective, it's still a good journey. We've been able to kind of hold a good shape of 20% levels of EBITDA for consolidated GCPL as a whole. It's coming in on the back of a significant margin improvement, which we've done over the last 2.5 years onto our international geographies. International geographies margins, almost 2 years back used to be at 10%. YTD 9 months is kind of gone to 16% level. So we've got like a big kick from our international geography margins. India margins, which are range bound between 24 to 27, have breached on the downwards. Definitely, we know that we can bring these and we will operate it within the band. Likely to take a quarter or 2 to kind of get back into that band, because in Q4 we will see some bit of a margin pressure yet, because still there is I would say, a spillover effect of palm oil, and while we've taken pricing, it will still take kind of time to kind of catch up to get those margins in that normative range. So we could see a few months to kind of get there, but we feel very comfortable operating within that banded margins, and it's temporary pressures which have kind of taken us off. So that's the way I would kind of respond to that.
Okay, all right, Asif, hi and welcome to the show. Could you tell us what about household insecticides business, which in the start of the previous quarter, that I think was impacted by delayed winter. Has that seen some kind of pickup in quarter 4?
So again, Mangalam, I think we're very happy with what I would say is our interventions in the household insecticides category, and how consumers have reacted to it. So I think we launched household insecticides, the incense sticks. That's done extremely well over the last couple of quarters, and it's kind of gained high single-digit market share in a very short span of time. and we are seeing a great runway to growth there. Our new product, which got introduced with a new molecule, is also seeing early green shoots of gaining share in the electric segment. So if you look at it from a segment performance perspective, we're kind of doing well in pretty much all the segments and showing early signs of gaining share in all of that. There has been a bit of a seasonality / I would say urban consumption stress for the larger industry as a whole. And we're hoping that that will kind of fall in place as we go along.
All right, so the industry is facing headwinds, but you believe that you're doing better out there. What about the Raymond portfolio? I mean, we did see a big growth in the KS business, that portfolio, but perfumes or deodorants, that's still struggling. What's the likely growth rate here that you're seeing?
That's right. So definitely KS has delivered a strong double-digit volume growth and is doing extremely well. Very strong green shoots in terms of ability to kind of bring in the new products and to kind of premiumize the portfolio. So quite happy with the sexual wellness part of the business. In terms of deodorants, we did take some time to kind of get a balanced GTM strategy. As we speak, we are seeing market share gains in urban. We are seeing market share gains in e-com. On the GT part of the business, especially in urban GT, we did make a few changes. The changes are falling in place as we speak. So we're quite confident that that part will also start seeing double-digit growth. So I think structurally, we're happy with the portfolio. Some bit of the corrections in terms of the sales system is something which we've made. So happy with the acquisition in totality.
All right. And earlier in the conversation, Asif, you did speak about the improvement that you've seen in your international business itself from around 10% to 16%. So the question is there more room for growth out there? I presume anywhere between 18 to 20% would be the international business band. Would that be a correct assessment?
You are right. I think there is a scope to kind of take up margins in the international business up by another 200 bps for sure. We will need to kind of consolidate. Given that we've had a good runway, we need to just consolidate margins at these levels and then build from here. But we do have plans to kind of take it up further. We're also seeing early green shoots in some of our international geographies in terms of the macroeconomic conditions. So like countries like Nigeria, countries like Argentina are kind of showing much more stability in terms of currency. We're seeing much more stability in terms of macro conditions compared to what it was a year and a half back. And that's also kind of supporting the journey to kind of hence lead improved conditions. But yes, there should be an improvement from here on.
All right, Asif, let's get some simple details out of you. What would GCPL look like at the end of FY26? You could give us a few details on revenues, margins, net profit outlook as well with the visibility that you have.
Yes, it is. I think it's interesting times. So I think would kind of wait possibly, Mangalam, for a quarter to kind of start giving guidance for FY26. We typically kind of do it after we close the year at the time of our annual conference. So let's wait for a week on that. But definitely we would want to kind of get back to our running rates of high single-digit UVG for the India business. Get margins moving towards normative levels, both in India and improving it for the international business. Pet care business, what we'd announced, the actions are progressing very well, both in terms of the product and in terms of the plant. So you should hear from us very soon in terms of our launch plans.
All right, we'll hear soon from your launch plans. Asif, thank you so much for joining in. Target moving towards single high-digit volume growth for the next year, along with margins towards that normative levels, though will take a couple of quarters for it to settle out here as well. The stock opened lower as the street saw those numbers, but thereafter there was buying at lower levels because a lot of that was perhaps priced in as well. Though the market's not in a good mood at all. The Nifty now down 250 points. We opened lower. Thereafter there was a recovery, and that recovery has been vociferously sold into. Currently at the low point of trade, the mid-cap index bearing the brunt as well. So what we'll do is take a short break. On the other side, shift full tilt to markets itself. Rahul Sharma of JM Financial Services joins in to discuss the market technicals, what the outlook is from here itself.
Welcome back. You're tuned into Chartbusters. You're on CNBC-TV18. Well, let's welcome our next guest. We have Rahul Sharma of JM Financial Services, who joins in for a technical check on the markets. Hi, Rahul. Good morning and good to see you win. Well, the market mood is a little bit subdued, but I believe you're thumping the table and you're saying that with the shorts in the system and give and take everything, you believe there's a good reason for the markets to see a rally from here? Give us the rationale and where do you think we're headed?
Yeah, very good morning, Nigel. So a couple of things happening over here. One is there is a clear bullish divergence on the momentum indicators like RSI, MFI. Last week, we did see FIs covering their index shorts. Around 3.5 lakh was the peak that they hit. And from there, as of Friday, we've come down to 3.09 lakh contracts on the short side. Now, there is also an important Fibonacci level placed around the 22,500 mark. We believe that 22,700, 22,800, which is where we are trading right now, offers a very good risk reward for a possible capitulation from here. We are also into the monthly expiry week, which means this could be the final leg of volatility, where we are seeing, selling across the board, mid-cap indices down like 2.5%, 3%, small caps also bleeding. So these are clear signs of that markets are extremely oversold. Also, the gap with respect to the US markets has widened to the maximum in the recent times. So we feel that from these levels, one can look to do some bottom fishing, possible bottom fishing with a stop loss placed at 22,400 on the Nifty. And once the bounce back happens, once the reversal happens, possibly from Friday onwards, which is where the new series begins, the budget is also something which is happening on Saturday. So we feel the bounce back can be at least 1,200 to 1,500 points on the upside from current levels.
That's a bold call you're making. 1,200 to 1,500 on the upside is a possibility with a 400-point stop loss that one can put in. Rahul, just one question. Because you believe that the upside could start from Friday itself, which is the new series, would you recommend those who are, acting on your trade or your idea to build positions in the next month futures as against this month itself and maybe do nothing for this series?
Yeah, absolutely bang on. So if you are into the derivative side, the best thing to do is buy the February futures for the Nifty. Alternatively, if you are looking to buy on the cash, I think this is a good time to buy Nifty ETFs and hold it for the medium to long term long haul. So, February is something where we are expecting this bit of a recovery in the market. And this recovery is something, which probably there are some stocks, like for example, the two heavyweights in the Nifty 50 space have not given bad results. I'm talking of Reliance and HDFC Bank. So these are the reasons why initially the market started following. And now I think there is some divergence building up in some of these counters. So selectively, in case you're trading stocks, it's best to be selective. Something like a Titan, Eicher Motors, Bajaj Twins. These are stocks which are, giving divergences, meaning they have not hit lower lows when Nifty has actually gone down to hit 22,800 as we speak. So these are the stocks where one could look to, cherry pick and buy these stocks for the February series.
Okay, all right. Just one query, Rahul. If you're expecting the Nifty to, see a good amount of bounce from here, the biggest constituent that's been an underperformer has been the Nifty Bank. Where does that find support?
Yeah, so Nifty Bank has almost reached to its support area. So 47,500 roundabout is where the crucial support for the banking index is. And like I said, the heavyweights at least are not witnessing fresh shorts in a big way. So that is something which is very close, to the support area. Now, having said that, between the two, I think it has to be the Nifty because it has the diversification of let's say an IT, let's say, FMCG, which is actually doing very well. So, the best thing to do is avoid banks at this point in time. Start with Nifty. Once Nifty gives a confirmation, then I think it is better to switch on to the banking side, which is relatively not really given a very strong reversal signal as of now.
All right, we take that point. Thank you so much for joining in. A bold call that you've made. Most definitely hold you on to this one, and we'll have a conversation perhaps sometime in the next week as well to test this hypothesis itself. With that, what we'll do is shift focus to our special segment. We get you a few ideas for profit coming in from our colleagues at Money Control Pro. Anubhav Sahu joins in with an interesting stock. He's positive on Laurus Labs, stock which is down 15% in today's trading session. Third quarter results were good, but the stock lower in today's session. Let's hear out what Anubhav has to say.
Well, this month is turning out to be a tough one from markets perspective, given global macro headwinds and continuous FI outflows. However, particularly in a period like this, bottom-up approach helps. One such improving underlying business data, Laurus Labs, company posted a strong Q3 led by ramp up in the new assets of the CDMO business. EBITDA margins have sharply jumped to the level of about 20% after 6 quarters, and Q4 results are expected to be even better due to scheduled project deliveries for late phase clinical programs. Now, company highlighted about a small molecule CDMO pipeline of 70 plus projects, wherein 10 products are commercialized. Further, companies working on 20 active projects in animal health and crop protection chemicals, which are undergoing commercial validation stage. Here, peak potential is expected by fiscal 27-28. In addition, company's new R&D facilities helping it to fetch early stage projects. Among other segments, antiretroviral sales are soft due to capacity allocation priorities, but biodiesel is doing well in terms of customer pipeline and capacity enhancement. In fiscal 26, we expect operational leverage and financial deleverage to help in exhibiting strong earnings growth, and therefore we believe one should accumulate the stock on any weakness.
Thanks a lot for that, Anubhav. Well, time to slip into a short break, though. Let's dive into the Growth Code, an initiative by Grow and CNBC-TV18, which offers valuable insights and strategies to help you make well-informed trading decisions. This week, in a special interview, CNBC-TV18's Prashant Nair interviewed SEBI whole-time member Anant Narayan and asked him about the risk involved in the derivatives market.
You've done a fair bit in terms of weekly options and other things. Or is that work in progress still? Is this going to continue to evolve, and we will see more sort of regulation and efforts to make people aware of the risks in this kind of activity?
You know, derivatives aid in price discovery. They give you depth in the market. They allow for risk management. They allow for trading, all of those things. And we do need all of these things for capital formation. So let it be very clear, SEBI is not against derivatives. We did have a problem, though, on two fronts. One was our first principal mandate is investor protection. And it was very clear from the two research reports that I quoted to you that small investors were losing out and that we cannot close our eyes to it. While we are a disclosure-based regime, we are not a nanny state. At the same time, we can't allow this to continue for a very, very long time. That is one particular issue. The second issue was we also saw a fair amount of over trading and therefore increase in system-wide risk, particularly on expiry days. And when we spoke to our market participants and we consulted with them, what we realized is that the core issue really is not across the spectrum of derivatives, but specifically in the area of index options trading on expiry day, right? So out of the 6 steps that we announced in October, 5 of them were clearly and squarely directed at trying to curtail this question of over trading in index options on expiry day. Now, we haven't directly tried to address investor protection, but by this oblique route of trying to bring down over trading on that expiry day in index options, we think that will have some kind of a benefit for investor protection as well. We've taken the first set of steps. We are still looking at how the impact is kind of playing out.
Welcome back. The market's still lower. A couple of stocks, though, very interesting moves out there. Signed after the big fall that we saw in the previous trading session is trying to make an attempt to recovery. Currently moving in the green in an otherwise wobbly market. But the other stock which continues to see selling pressure is Kalyan Jewelers. That stock at yet another low point of today's trading session has fallen almost 45% in just the last 7-8 trading sessions itself. Reports its numbers this week. So it'll be very, very crucial to track what happens post the results are announced, whether promoters go ahead and act on the stock itself or not. But meanwhile, for the markets, no respite really. Even though the Nifty bank has come off slightly from the lows, the Nifty is still down by almost 250 points. So what we'll do is take your leave on this edition of Chartbusters. On the other side, we have the team of Trading Hour coming up with all the market action next.